Hello guys, my name is Joseph Ejike Oji. Um, the topic of our discussion tonight is the valuation of stocks and corporations. Simply put, it means how to value stocks. Before I do that, I want to refresh your memory on what stocks are. You can call them stocks or you can call them shares. Let me make sure that you're seeing this. Okay, I think you are. Matter of fact, let me take care of one more thing here because I think I opened so many pages. Okay, I'm closing this page. Good. Now I'm gonna share my page again. Excellent. So, like I said, I'm going to refresh your memory about what stocks or shares are. I've already done that in my previous lecture, but let me refresh your memory. I'll take you back a little bit to stocks. Now, a stock is or a share simply means ownership. So when you buy shares in a company or a stock of a company, it means that you are one of the owners of that company. So every public companies, those when I say public companies, I mean those that are traded in the stock exchanges, are owned by shareholders or stockholders. Let me be more elaborate by giving you an example. Suppose that you like a company like Bank of America, or maybe a company like Walmart. I think Walmart should serve a good purpose. Okay, let me share it. So suppose you want to own a stock. You want to be one of the owners of Walmart. To do that, it means that you can buy Walmart shares, the shares of Walmart. So if you can look at my screen, I can show you how much Walmart is trading right now. The symbol for Walmart is WMT. So the current share price or stock price is $130.64 per share. So if you buy 100 of this or 1,000 of this, depending on how much rich you are, then they say that you buy 1,000 of these shares. That means you became one of the owners of Walmart. This entitled you to a share of the profit of Walmart. Good. So that is what shares are. And for every company, when the shares price are going up, it means that the company will have more value. When it's going down, it means that they are losing value. At least that's how the market sees it. And then another thing that you need to know is that there are two major types of shares. One is the common shares, or what you call the common stock. The other one is the preferred stock. Now, if you buy common stock or common shares, then you are entitled to dividends, what you call dividends, that vary in amount and may be missed because sometimes the common shareholders or common stockholders, some company doesn't pay dividend for years, but usually, so long as the value of the share is going up, the common stockholder doesn't care or don't mind, so long as the company is adding value. So if you buy a common share, you are entitled to dividend. Dividend simply means a share of the profit of the company. Now, so when also as a common shareholder, you are you have some common rights, what you call voting rights and privileges. Why? Because why do you have those rights and privileges? Because one reason is that sometimes company doesn't pay you anything, no share, you don't receive any dividend for years. And also, if the company is going out of business, maybe they're going bankrupt, the shareholders, common shareholders, will lose their money because the company will first of all settle the lenders, then settle the preference shareholders, and if nothing is left, then you lose. So Because of that, common shareholders have to compensate you for that. They give you some voting rights. So the common shareholders can vote to select corporation's board of directors. Also, as a common shareholder, you have the right to vote on major issues that faces the company, such as the corporate charter changes, or if the company want to merge with another company, and so on and so forth. Now, for the preferred stock, which is our preferred share, this one, they are entitled to some, they have guaranteed dividend payment. So they receive a fixed dividend forever. So each time the company declares profit, you receive part of the profit. Also, when a company goes out of business, after settling their lenders or creditors, the preference shares are the next to settle. Now, because of all these privileges that they have, they don't have a voting power because they are guaranteed dividends, and also in the event of liquidation, preferred shareholders or preference shareholders are paid off before the common shareholders. So now all this are one of the benefits of preferred shareholders. Another one is that the preferred shareholders, preferred stock are callable, which means that the company has the option to purchase the shares from preferred shareholders at any time for any reason, usually at a premium. That means at a profitable price. So all this is like as a preferred shareholder, you have your risk is covered, But unlike the common shareholders, which they're not guaranteed dividend, and also they don't receive any settlement when the company goes bankrupt. But as a compensation for that, they are given some voting rights and privileges. So I believe that by now you get a point of what a share is and the types of shares. Now, let us go back to our main topic of the day, which is how to value companies, value stocks and corporation. Like I said, it is a valuation of stocks and corporation. So simply, the first thing we need to know when it comes to valuing companies and stock is that the price of an asset is the same as the present value of its future cash flows. When I say assets, I mean things like shares, stocks, and bonds. For tonight, our asset of tonight is shares or stocks. This means that the price of a share or an asset is equal to the present value of its future cash flows. The cash flow might come in the form of dividend payment or capital gain. So for an investor holding a common stock for only 1 year, the value of the stock should be the present value of both the expected dividend to be received in that year, which is represented by D1, and the expected market price per share of that stock, which is represented by P1. So in mathematical terms, they mean that the value of the common stock will be, which is represented by PO, is D1, which is the expected cash dividend in that year, that 1 year, divided by 1 plus R to the power 1, plus P1, which is the price of the share that year, in year 1, divided by 1 plus R to the power 1, where R represented an investor's required rate of return. When we look at this formula, you see that it almost is a formula, is similar to the formula of present value. Remember that I said that the price of an asset is the same as the present value of its cash flow. Now, let me show you how this formula, why this formula is the same as the formula of present value. I'll take you to where you can see the similarity. This is the formula for present value. You can see that the present value formula is future value given the number of periods divided by 1 plus R to the power n, where PV represents present value, FV represents future value, R represents rate of return, and N represents number of periods. So you can compare this formula to the one we have in the PowerPoint presentation. You can see that here we use, this is the first cash flow. So we use D1 to represent, substitute for the future value. And the rest is the same, 1 plus R to the power n, which is the same as saying 1 plus R to the power 1. N is 1 year here. N is represented by 1 year. So you can see that the same thing with this part. Use P1 to replace FV, which is future value, and 1 plus R to the power 1, where R1 is represented by N in the future present value formula. So our N here, N is number of periods. So in that case that we have in our PowerPoint presentation, it said in 1 year, so our N is 1. So you can see that this is what it is. The price of an asset is equal to the present value of its future cash flow. Now, I believe you get the point now. We can move on to the next stage. It says, next stage will be to answer some sub-equation. It says, assume that an investor is considering the purchase of stock A at the beginning of the year. The dividend at year end is expected to be $1.50, and the market price by the end of the year is expected to be $40 per share. If the investor's required rate of return is 15%, find the value of the stock. Okay. Now remember that the value of the stock is similar to the present value of the cash flows. So let me write this down. You can see the formula here. So here we have that D1 is, the first dividend is $1.50. Okay, $1.50 dividend year 1, and then P1, the price, P1 equals, say that it is $40 per share. $40 per share. Then R, which is in the rate of return that investors are expecting, is 15%, which is 15%, which is 0.15. So I'm gonna write this down on the paper. D1 equals 1.50, $1.50. P1 is $40 per share. Return rate is 15%. So let us answer the question. The question says, find the value of the stock. The value of the stock is represented by PO. So I'm taking you to where I can put this in Excel. You can see the value of the stock right here. So our return is 15%. And I can see that 1 is a part of the formula. So I put 1 here. Let me make this thing bigger. I think it's more. Okay. Yeah, that's better. So 1 is a part of the formula. So you can see I put 1 here. Making sure that you can see this clearly. Okay, good. Now, dividend in the first year is $1.50. Okay. Stock price in the first year is $40. Remember that these are in money, so I'm going to change the dollars. Okay. Now, value of the stock. Which is what we are looking for. I'll make it red and bold. Value of the stock becomes equal. See the formula here. D1 divided by 1 plus R to the power 1, because 1 is the first year, and P1 price and the first year. Then this is rate of return R. So you have equals. D1 is dividend 1, divided by 1. So 1 plus r. So 1 plus r is here. Rate of return. Okay, raised to the power. Use the cap symbol. This is raised to the power 1. Okay, close it, the parentheses. Plus, because you have a plus sign here. Next is P1. I will put in the parentheses. P1, which is the price, divided by, put the parentheses. So 1 plus R, that means 1 plus R. Okay. Raised to the power 1. So raised to the power is a cap symbol. And 1. Then close parentheses. Now, when you press the enter key to give you the price and the value of the stock in the first year, $36.09 per share. $36.09 per share. See? So, and if you look, and you look at the PowerPoint, you discover I got the same thing. $36.11. I got $36.09. So this is 36. It is the same $36, but it's just a difference of 2 cents, which it can be attributable to rounding error, and is negligible. $36.09. So now, I hope you understand this, and I want to show you how you can do this using a calculator as well. So, assuming that you are using a regular calculator, you can just put numbers in. So I'm going to show you from the calculator. So you can have this as, first one was D1. If you look at it, you will see that it is D1 divided by 1 plus R to the power 1. Okay, and the D1 is $1.50. So we have okay, say D1 is $1.50 divided by, okay, excuse me, I put it the wrong way. Put $1.50. Okay, I'll start all over. Okay, so D1 is $1.50 divided by 1 plus R is 15%, 0.15. Okay, raised to the power 1, not 2. Raised to the power 1. 1. Okay. Plus our next one will be P1, which is $40. Raised to divided by 1 plus R to the power 1. So we have $40. $40 divided by, okay, divided by, okay, let's see. All right, 1 plus 0.15, which is 15%, raised to the power 1. I got 36.09. You can see that. 36.09. So something I have in my Excel calculations. See? So that is the value of the stock. Remember, the question was to find the value. If the investor's required rate of return is 15%, find the value of the stock. So the value of the stock will be $36.11. Oh, sorry, or $36.09, which is what I got from my calculation. So this probably might be typo 11. It should be $36.09. Now, let's see if we can move on to the next stage. Next stage will now become when we do the valuation. There are things, the general common stock valuation model we use is because since the value depends is basically the present value of the cash flows. We say that common stock has no maturity date. So that means you can hold it forever if you want, or you can sell it after some time, you know. So since common stock has no maturity date and it is held for many years, a more general multi-period model is needed. Excuse me. And that general common stock valuation model is value of the stock or price of the stock is the sum of DT, which is dividend at a time T, or you can use N here if you like, divided by 1 plus R to the power T. T can write it as T or N. In each case, it represents the number of periods, and R is the return, expected rate of return, and D is the dividend. And you can use D as if it is P, you can use it as capital gain. So because that cash flow can be either a dividend or capital gain. So this means sum of from year 1 to whatever to the number of years that you needed. So that's why we put the infinity symbol here. Sum of. So you keep adding the dividend for each year. I mean, keep putting them in this formula for each year until you reach how many years that the stocks was kept on hold before it is sold. Anyway, I think you got the point. Now, there are 3 scenarios, I'll call it 3 cases that we can use or apply when we try to evaluate stock. 3 scenarios or 3 cases. The first case is zero growth rate, where the dividend does not grow at all. Constant growth state, and when the dividends grow at a constant rate. Then non-constant or supernormal growth rate, which is one that is common, because a company make profit this year. Let's say they make a small profit this year, they might pay dividends, small dividend, and they make higher profits, they can pay higher dividend depending on their dividend policy. So that one is more common. Now let's start with case 1. Case 1, valuing a zero growth stock. In this case, the dividend does not grow at all. So it means that if the dividend is $1, well, what's the best way to explain this? That it doesn't grow at all. It doesn't grow at all. So if it's $1, it's gonna be $1 forever. In that case, PO becomes sum of DT over 1 plus R to the power T. Again, remember that T represents the time, number of periods, and this is the sum of from period 1 to the last period that you have. So it's DT over 1 plus R to the power T. So because the dividend does not grow at all, so you're gonna be just DT over R. So in that case, to value the stock, use this simplified formula, DT over R, since it doesn't grow at all. Good example, a company pays an annual dividend of $3 per share, expect no growth on future dividends, and has a required rate of return of 12%. What is the price of the stock? To answer this question, let us put this in perspective. I'll put it right here. I'm going to make this 20. So in this case, yeah, I think you can see it. The dividend DT for any time at all, because it doesn't grow, is $3. And the rate of growth, required rate of return R, is 12%, or what's it called, 0.12. So you can go and put this in the calculator if you want. Otherwise, you can just put, in that case, you have the value of the stock becomes $3 divided by 0.12. So in the calculator, if you're using the calculator, you have $3 divided by 12%, which is represented by 0.12, is $25 per share. So $25 is the worth of that, the value of that company, or the value of the share. So you can see right there, $25. So, and that's it. So if we have case 1, that's what you're going to do. Now, case 2 is the scenario or a situation where we have a constant growth. So the dividend might be growing by 1% or by 2% every year. Each year keep growing by 2%. So it's a constant growth dividend. For this, we use what they call the Gordon growth model. So if we assume on this model, according to this model, if we assume that dividend grows at a constant rate of G every year, so that is dt equals do times 1 plus G to the power T. And in that case, Gordon growth model means say that PO, which represents the value of the stock, is D1 divided by R minus G, where D1 represents price per share for 1 year in year 1, and D1 represents the expected dividend in the next year, that's year 1, and DO represent the dividends per share, latest one paid, and R is the required rate of return, and G is the growth rate of dividends. So to apply this, we solve this question here. It says, consider the common stock. Yeah, it says consider the common stock that paid $3 per share at the end of last year. So, and is expected to pay a cash dividend every year at a rate of 10%. See, constant growth rate of 10%. Now, so we have assume that the investors' required rate of return is 12%. Estimate the stock price. That is the value of the stock. So again, first of all, we write out the values. So we have that. Okay, D1, DO, first dividend, the latest dividend, DO is $3. Okay, and the growth rate G, constant growth rate, is say that cash dividend every year at a growth rate of 10% is 10% or 0.10. And then rate of return is 12%. Okay, or 0.12. So now we have let me write this in down. The latest DO is $3. G, which is growth rate, is 10%, and investor required rate of return is 12%. Now, investors, because you say that that they paid $3 dividend per share at the end of last year, and the dividend is expected they are expected to pay a cash dividend every year at a growth rate of 10%. I think that the investor required rate of return is 12%. Estimate the stock price just for 1 year, for the 1 year. So we need to estimate the dividend for that 1 year using this formula here. Before we can now put them into the result into this formula here to get our value of that stock. So let's go and put them in Excel. So we have it as, okay, we have this here. Dividend last year is $3. Make sure you can see this. Yeah. Then required rate of return is 12%, R 0.12. Then growth rate is 10%, which is 0.10. Then you can look at this. You can see that one is there's something. Oh, okay, because this is, we need to calculate it. Since this one is this question is asking us for It says, and paid cash dividend every year at a growth rate of 10%. So assuming that its investor required rate of return is 10%, estimated stock price. Now it said this stock paid dividend per share at the end of last year and expected to pay dividend every year. So we are looking for the value for the first year. You know, because that's how much information we have so far. So that means we need to estimate the dividend for the first following year, but the latest dividend was $3. So we go there and then we have one. If you look at the formula here, D1 1 plus G, D1 is DO times 1 plus G, and so you can see that 1 is part of the formula, so I put 1 here. Okay, now the dividend this year will be D1 equals DO times 1 plus G. Okay, D is the latest dividend will now become, dividend this year will now become D1, which is the actual DO. The latest dividend for this year will be D1, and the formula to getting it is DO times 1 plus G. Our DO is $3 latest place times in parentheses 1 plus G, and G is the growth rate of 1%, 10%. You close the parentheses and press the enter key. So this gives us dividend this year. Remember, these are in dollars, so I'm gonna put it in dollars. Put this one in dollars as well. Now, so to answer that question, which is the question asked us to find them. It's a find estimate the stock price or the value of the stock. So to estimate it, we use the Gordon model. See the Gordon model here. Okay, with this is the growth model here. Now we use that to estimate the value of the stock, and that gives us this equals D1, which is this year dividends, divided by R minus G. R is the rate of return, which is 12%, minus growth rate of 1% and 10%. And that gives us the latest value of the stock, which is $165 per share. Okay, you see right there, $165 per share. See, very easy. And when you look at our work here in the PowerPoint presentation, you can see that the same answer we have. So that's the value of this stock, and this is for the case 2, which is valuing a constant growth stock. But usually stock does not grow at a constant rate most of the time. They might go, dividend does not grow at a constant rate at the time. Company might have a dividend policy, say okay, 10%. They might say that it might be, but most time it's more flexible, which is case 3, where you have company making so much profit. It's okay, we're gonna pay 5% of the profit, 10% of the profit as dividend. When the profit goes down, it's okay, we are going to pay only 1% profit. So this is the more possible situation, the case 3. So which means it involves valuing non-constant or supernormal growth dividends. Generally speaking, companies can go through life cycles, and during that life cycle, part of the life cycle might be that they're growing faster, then later on slow down. There are many companies that have been through that. There used to be a time when BlackBerry came out as one of the first smartphones we have. They grew very fast. Then Apple came in with a more sleek and more useful smartphone. BlackBerry growth plummeted. How about the days of the heyday of the newspapers, when they were growing so fast? Then the internet came, and then many of them actually went out of business. Those that still remain, like the New York Times and the rest of them, their growth rate is very minimal. There are many instances of that. So, and the most recent one is the oil companies, oil industry. During the before 2014, they were growing very fast. Their growth was very robust. Then, when the oil market collapsed in 2014, oil fell from almost $120 per share to about $29 per share. They fell. Now they are growing very fast again since the Ukraine and Russian war began. Anyway, I think you get the point. So firms typically go through life cycles during a part of which their growth is faster than the economy and then falls sharply. So the value of the stock during this such supernormal growth can be found. But to find the value of the stock during those times, you have to do three things. First of all, you have to compute the dividends during the period of supernormal growth and find the present value of those dividends. Next, you find the price of the stock at the end of that supernormal growth. At the end of that supernormal growth, and then find their present value. Then add these two present values. That will give you the value of that stock or the value of the company during the supernormal growth. So let's try an example, maybe two. Who knows? Says consider a common stock whose dividends are expected to grow at a 25% rate for 2 years, after which the growth rate is expected to fall to 5%. The dividend paid last period was $2 per share. The investor desired 12% return. Find the value of the stock. Again, remember, you compute the dividends during the period of supernormal growth and find the present value of that dividend. Find the price of the stock at the end of that supernormal growth and the present value of that price. Then add the two present values. But before we do that, this is actually example 6, and I wrote example 11 here. Example 6. Okay, as question 6, I mean to say. This should be actually, matter of fact, I should not even put question 6 there. I should put, because it's still the value of stock, valuation of stocks. Okay, valuation of stocks is enough. So I'm just gonna save it so you don't have to worry about it anymore. Okay. So in this case, it's a consider the common stock whose dividends are expected to grow at 25% for 2 years. That's a supernormal growth. After which growth rate is expected to fall. See, it fell 5%. The dividend paid last period is $2 per share. The investor desired 12% return. Find the value of this stock. So first of all, we compute the different dividend during the supernormal growth and find their present value. So assuming that the dividend paid last year was $2 per share, and the growth rate, see, dividend is $2 per share. Let me write it down. DO is $2 was paid, and the growth rate G is 25%, which is 0.25. I have it. You can see it right here. I'm gonna make sure. Yeah, like that. And the rate that the investor expects. You as an investor, you say, okay, I want this stock to grow at this rate, or you might check their the stock price for that company over the years and calculate their growth rate, and can decide, I want it to grow at this rate, 12%. So R is 12%. So we need to find because if we say for 2 years, we need to calculate the dividends paid, or estimate the dividend paid in year 1, year 2, using this formula here. D1, formula for D1 and formula for D2. But first of all, once we get that, then we can get the present value by plugging it into this formula here. So let us go to and put these numbers in first and calculate that dividend and present value. After that, we look at the price of the stock and calculate the present value. Okay, price of the stock at the end of the supernormal growth, then calculate its present value. But let us do the first part, which is to to compute the dividend during the period of supernova growth and find their present value. Okay, so we have our numbers that dividend that was paid last year was $2. Growth rate, which is the supernova growth rate, is 25%, and the rate of return required for investors is 12%. So we can calculate the first dividend this year and next year for that 2 years. So we go to our Excel and put those numbers here. Last year dividend is $2 per share. Investor required rate of return is 12%, 0.12. Supernova growth rate is 25%, which is 0.25. Okay. Now, non-supernova, when it wasn't growing, when it fell down, it fell like after at the end of the supernova, at the end of the supernova growth, the growth rate fell to 5%. See, so which means that the non-supernova growth rate is 5%, which is 0.05. Now, as you can see, 1 is part of the formula here, so I'm gonna put 1 here. Now, so the growth rates for year 1 and year 2, we can use this here formula here to calculate them. See, so D1 become DO times 1 plus G. DO is $2 times, okay, 1 plus G, which is greater than 25%. That gives us, press the enter key, give us $2.50. Remember, this is our dollars, so I'm going to make it $. And this is dollars, make it dollars. And D2 is D1 times 1 plus G. D2 equals D1, is this, times, okay, excuse me. D1, which is, this is D1 here, times, okay, 1 plus 2. 1 plus, okay, excuse me, I got there. Now, give me 1 minute. Equal D1, which is this one here, times 1 plus G. 1 plus supernova growth rate. Okay, that gives us this total 13 cents. I can see that from here. Okay, if you run the total 13 cents. Okay, now after that the growth rate fell to 5%. That's non-supernova growth rate. So that means to calculate non-supernova growth rate, you can see right here, non-supernova growth rate equals have this, which is day 3. Give me 1 minute. I'll check something here. Price. So a mistake. We are doing good. We are doing okay. So non-supernova growth, we just we can leave it for now since we are just doing the supernova growth rate. So let's leave it for now. So that means the present value, supernova growth present value, you can do that here. I'll show you the formula from here. Here. So the present value for the supernova growth rate, growth period, see D1 divided by 1 plus R to the power 1 plus D2 divided by 1 plus R to the power 2, because it's for 2 years. A 2-year period of supernova growth. So we have it here. So supernova growth present value, or the present value during the supernova growth rate, okay, is given by here equal, okay, to D1, which is right here, D1 divided by 1 plus R, and R is rate of return is 12%, Okay, raised to the power is the cap symbol. Raised to the power 1, okay, close the parenthesis, plus D2, which is this one here. The supernova growth dividend for year 2. Okay, D2. Okay, okay, divided by 1 plus R, which is rate of return, raised to the power, which is the cap key, 2 this time, second year. So you can now close the parenthesis, and then when you press the enter key to give me the value at that time, which is $4 72 cents. Okay, that's what the dividends is then. Now so we have done the first part, which is to compute the dividend during the period of supernova growth and find the present value. Next thing is to do now is to find the price of the stock at the end of the supernova growth period and compute its present value. To do that, we know that we need to calculate the D3, which is the price at the end of the dividend at the end of the third year, because that's the third year, it ended the second year, so we need the third year dividend. Right, so you can see that this is D2. We need D2 to get we need the dividend for D2 that was calculated before to get the D3. But when we are calculating D3, remember this time the growth rate have fallen to 5%. So while calculating D3, we're gonna use 5%, not 25% anymore. So in that case, we have D3 will be D2 times 1 plus G prime, where G prime, not G this time, but G prime, where G prime represents the supernova, the growth rate, non-supernova growth rate, and I have it here as 5%. So that D3 equals D2, here D2 times 1 plus G prime, D2 times, okay, 1 plus G prime, which is non-supernova growth rate, which is 5%. Close it, then press the enter key. Then, now let us find the present value of this dividend. The present value of that dividend is this. So remember that the requirement was to, don't forget that the requirement was to find the price of the stock at the end of the supernova growth rate and compute its present value. So to find the price of that stock, we need the dividend. Estimate the dividend after the growth supernova growth period. So we did it, and we get it as D3, so that the price now becomes P2, because the supernova growth lasted for 2 years. So P2 now becomes D3 that we just got divided by R minus G prime, just modification of the Gordon model by just representing G with G prime. So we have the price now become equal D3, which is here, divided by, okay, R, required rate of return, minus G prime, which is the non-supernova growth rate, this one here, and that gives us $46.88. So that is the price during the supernova growth rate. Okay, now at this point we are going to calculate the present value during this non-supernova growth rate. Okay, the present value of this price becomes the formula is the present value of P2 divided by 1 plus R to the power 2. To the power 2 means that because the supernova growth rate ended after 2 years. So we have the present value as this. equals P2 that we just got divided by 1 plus, okay, R, okay, raised to the power, which is represented by the cap key 2. This $37.37. So now we are ready to find the value of the company or the stock. Remember that the first thing we did was to compute the dividend during the period of supernova growth and find their present value, which is this here. The present value of the dividend during the supernova growth is this. See, supernova growth present value is this. Okay. Next is to find the price of the stock at the end of the supernova growth and compute the present value. We did that. We find the price of the stock at the end of the supernova growth to be $46.68, and the present value of that is $37.37. Now, next to do is now becomes to find the value of the stock. Okay, is to add the two present value, add the present value, the PV figures to find the value P of the common stock. So, which is what we're about to do now. So we add the two present values to find the value of the stock. The value of the stock will now become equal the present value of for supernova growth plus the non-supernova growth present value. That gives us the value of the stock, $47. $42.09, which I'll highlight with light gray. See, $42.09 is the current value of that stock. See, 9 cents, and I have 8 cents here, just rounding error. So that's how we do the for case 3. I'm hoping that you are getting the point here. We can now proceed to the next step, which is expected rate of return on a common stock. The formula for computing the expected rate of return can be derived easily using the valuation model. So for single period formula, we have it here. PO, which represents the value, is D1 1 plus R to the power 1, then P1 1 plus R to the power of 1. So this is for the single period, that's for 1 year. From here we can derive the valuation models. If you solve this using algebra, excuse me, and make R the subject of the equation, we get this. R, which is the rate of return, is D1 plus P1 minus PO, where P1, D1 is dividend for year 1, P1 is the ending the price of the stock at the end of year 1. PO is the price at the beginning stock price. P1 is the ending stock price, ending dividend. PO is the beginning divided by PO. In other words, it means that dividend rate of return is dividend plus capital gain. This side represents capital gain divided by beginning price. Okay. So, in other words, the rate of return is dividend yield plus capital gain yield. Let's see how this works. They say consider the stock that sells for $50 per share. The company is expected to pay $3 cash as dividends. Okay. At the end of the year, and the stock market price at the end of the year is expected to be $55 per share. So you say the expected return, find the expected return. So I think I'm gonna put it this way. compute the expected return of the stock. Compute the stock's expected return. Okay. Okay, so I can save it now. Compute the stock's expected return. So we plug in this is the formula we are using, D1, which is the end of year 1 or dividend yield. Then we have P1 minus PO over PO. So let me write this down. Our D1, say consider a store that sells for $50 per share. So that means our PO is $50 per share. The company is expected to pay a dividend of $3 in cash dividend. Okay, so that our D1 is $3 per share, and then at the end of the year, the stock market price for that stock will be $55 per share. So that means P1 is $55. So we go and plug these things in, and you get your the expected rate of return. So I'm taking you to the Excel. So you have D1 is $3. Okay. P1 is $55 per share. Okay. Now PO is $50 per share. So that we have that rate of return will now become or the expected return will now become equals to D1 plus P1 minus PO. Have D1, okay, I'll put it in parentheses. Okay. D1 is this plus say P1 minus PO, that means this $55 minus $50. Okay, close it properly. Divided by PO. PO is $50, and that will give us the return. So you just have to change this to percent. Make it red and bold. Change it to percent. 16% return. Okay, 16% return. That's it. That's answer the question, and you can see it from our presentation at 16%. Okay. Now, let's look at the constant growth dividend. When there is a constant growth dividend, the rate of return for a constant growth dividend. So assuming that the growth is in this dividend, assuming a constant growth in dividend, now the formula for the return will now become R equals D1 over PO plus G. For example, it says suppose that the ABC company dividend per share was $4.50. That means D1 is $4.50, and it's expected to grow at the rate of 6%. So G is 6%. Okay. The current price of the stock is PO, which is $30 per share. Find the expected rate of return. So you can go and put it in so that we can get our rate of returns. This is a constant growth stock. So for constant growth stock, we have that we need our three things. We need D1 is $4.50. Then we have G small g, which is growth rate, constant growth rate, is 6%. And then next we have, actually this is constant growth rate, so constant growth rate, which is G. Then next thing we need is, according to the equation say that the price of the stock is $30 per share. See, the price, current market price, which is PO, is $30 per share. Current market price is market price. Okay, market price of the stock is PO, is $30 per share. So now what we're looking for now is the equation says to find the expected rate of return. So this is the formula we use. R, write this down. R equals D1 over PO plus G. So expected rate of return becomes the expected rate of return R, rate of return R becomes equals, I have D1, I'm going to put it in parentheses, D1 divided by PO, which is $30 per share, plus R, is right here, plus G, plus G, I mean to say 21%. If I can, let me make it red, color and bold, and highlight it, then change this to a percent. 21% is the rate of expected rate of return. 21%. So, and you can also see it from my calculations in the presentation right here, 21%. So, I hope you enjoyed the lecture so far. And if you do, please subscribe to my channel so that you can receive notification when I have a new lecture for you. Thank you for listening and watching, and I wish you a good night.